Hello, Rich. How are you, sir?
I'm doing great, Dan. How are you?
Wonderful. Hey, it does take them a little bit to get logged in, so we'll get
Yep.
lost. I know that we sent out a second text just a second ago, so
Yep, not a problem.
how's your weekend?
It was good. It was good, actually. I am loving this time of year compared to what I went through in July and August when I moved down here. So it's just beautiful. You know, anything between 90 and 100, perfect. This will be the first one of these I've done kind of a training class type setting in Zoom. So we'll see how this goes. Wish we could be live.
One day we will again, sir. One day we will again.
Hey, Dan. Hey, Rich.
Hi,
Hello.
Teresa.
Hey, Dan. I know you said you was wanting to order some more books from Keller Inc. To save shipping. You want me to just tag yours on with mine when I order some? Just let me know which ones you want.
Yeah, Kayla just did.
Oh, okay. Okay.
I appreciates you. How was everyone? Turn your cameras on. Let Rich see your face.
I've already scared him once.
I would, but I'm driving. I didn't want to miss out.
Yeah, careful driving.
Hey, Robin. You're mute.
I love you guys mute yourselves and don't talk. All right, guys, let's hear from you. How's your weekends? How's everything? What kind of wins do we have?
Well, I didn't have a win. I want to know how you would handle this. Had a buyer's appointment Saturday and they didn't show up. And I called Friday to make sure we were still on. Oh, yeah, we'll be there at 3. And they didn't show up. I waited half an hour and called. They answered. I said, hey, this is Teresa, Keller Williams. Click. I'm like, they just hung up on me. So I text her, hey, I'm sorry. Do you need to reschedule? And they didn't answer. So I don't know. I haven't been feeling well. I hope I'm not expressing a grumpy old lady syndrome, but I'm trying to hang in there and put on a happy face.
That's strange. And did you text them at all?
Yes. They didn't answer. So I don't know what happened. I promise I didn't upset them.
That's strange.
Yeah. I might have Teresita call them and I don't know.
Well, this is who's joining us. This is who's joining. I'm gonna throw it in the group chat. We got one more. We got Cindy jumping on. Okay, I'll be out there soon after you, Robin. I gotta, once I close this down, I'm heading that way.
Sounds good.
So. All right, well, let me see if I can get the invite link sent one more time. Copy invite link.
Yeah, it worked. I didn't need a passcode or anything. Went right in.
Amber says she's trying to log in. Doesn't seem to be working.
I went through the calendar and it worked fine.
Yeah, I did too. Just tell me to go to the KWSA. It goes through fine.
There she is. We find her. Yeah, that's what I would do, Teresa, is I would just give it some time to cool down. We don't know what changed in their lives. We can come back to them and say, hey, this is Teresa. I just want to follow up you to make sure that I didn't do something to upset you and wanted to follow up with you and see where things were at.
Yeah. It's kind of unusual, but
Very little unusual.
yeah.
Awesome. Well, I want to give Rich his time. It is 2:38. I want to introduce, this is Rich Osborne. He is our loan officer with IntraLend. That is the internal Keller Mortgage company that we have here. It's not Keller Mortgage. It's the internal mortgage company we have here at Keller Williams, Southern Arizona. He's going to go over some things, the applications that we have, the process for our app, as well as answering any questions you have and giving us an overview of what to expect in lending, maybe some key points that you might want to take and some learning points that might help you out. So, Rich, go ahead.
Oh, thanks, Dan. Thanks, Dan. Good afternoon, everyone. Hopefully you had a wonderful weekend, except Teresa. Sorry to hear that. That unfortunately, I can say it's happened to probably all of us, including me. So yes, I am with IntraLend. And before I get started kind of in the intro to mortgage piece, does everybody have our IntraLend app on your phone? Has everybody downloaded that? Yep. Thumbs up. Okay. Yeah. If you want some help downloading it or it's not quite set up, please let me know. I'd be more than happy to spend a few minutes with you to get it up and running. It's pretty slick. I know, Teresa, you've used it, Dan, and some others as well. So definitely want to get the word out that we love that app. All right. So I talked to Dan last week, and we thought it might be interesting for me to put together kind of an intro to mortgage lending class, more of a high level overview. Hit on the different kinds of programs, some of the requirements and differences, as well as I can share some stories about some things that I've been involved with over the years, and some went really well. Others, unfortunately, not so much. Again, happens. This is real estate. It happens to all of us. So I'm just going to jump in. If you have a question, either maybe post in the chat or just raise your hand, or just please interrupt, and I'll do my best to recognize you and answer your questions as they come up. But so let's start here. So with mortgage lending, there's different types of programs. We've got conventional loans, Fannie Mae, Freddie Mac type loans. We've got government loans. Probably heard of VA, FHA, those types of loans. There's a Department of Agriculture loan that is often used, USDA. I don't know if you've ever heard that term. And then there's what I call specialty loans. Those would be things like maybe custom construction, renovation, HUD 184, down payment, maybe some down payment assistance stuff. Those are programs that are fairly specialized, and you want to make sure hopefully you're aligning with somebody that kind of knows what they're doing and has some experience. And then there's kind of the non-qualified mortgage, the non-prime kind of Alt-A. These are programs maybe where the borrower, their scenario doesn't quite fit in the box. And there are some options out there for those. Most require a little larger down payment. They're a little more, they can be a little more challenging at times. So those are kind of how I group the various programs. The world, I think that most of us probably experience for more the conventional FHA, VA. I did custom construction in my previous position before I came down here for a number of years. Loved them. So I've got some experience there. Unfortunately, our company, you really need to probably go to a community bank or like a Washington Federal. They kind of handle those. So let's talk about conventional loans. So conventional loans, Fannie Mae and Freddie Mac purchase the overwhelming number of conventional loans that originate out there. And what that means is that when a lender originates one of those loans, whether it's Intralend or Fairway or Cardinal or VIP or Nova, generally what happens is those lenders will close the loan on their warehouse line, and then they'll sell that loan in the secondary market to Fannie Mae and Freddie Mac. And when they buy the loan, then it frees up that warehouse line to be able to go out and lend more money on additional loans. And we're talking millions and millions and millions of dollars on these credit lines. So there's a lot of loans getting closed and then ultimately sold off to those agencies, Fannie and Freddie. Fannie and Freddie require private mortgage insurance, meaning that if the borrower makes less than a 20% down payment, there are private mortgage insurance companies that will insure the lender should the borrower default on the loan. And these are companies like MGIC, Essent. They're insurance companies that insure the lender against loss in case of foreclosure. Fannie and Freddie, you may or may not have ever even known or had a reason to know which way your borrowers were going, whether it's a Fannie Mae loan or a Freddie Mac loan. Generally, probably 97, 98% of the time, the guidelines are pretty similar, if not identical. There are some nuances that do come into play on certain transactions that may help, hopefully if the lender recognizes it, that get a loan done one way that might not necessarily go another way. I had one come up recently where one of the probably the really unique things is Freddie Mac, when it comes to student loans, is a lot more lenient on the payment calculation for a borrower than Fannie Mae. Fannie Mae counts basically double the payment that Freddie Mac does. So if you've got a borrower that's tight on ratios, maybe they're at 48, 49%. If you try to take them Fannie Mae, they may not be able to afford much, but if you take them the Freddie Mac path, even a $400 difference, that's $90,000 in qualifying power. So I had one that it worked out great. Freddie is able to do it, and the borrower is able to qualify for the amount of home that she wanted to purchase. So again, these are loans that the underwriting rules pretty similar. Generally, the debt to income ratios you're looking at anywhere from 45 to 49%, with some caveats there. But so then the next kind of category of loans, really the government loans. Let's talk about FHA. FHA is insured by the government, as is VA as our VA loans. And instead of Fannie Mae and Freddie Mac purchasing these loans, they're sold into what's a pool known as Ginnie Mae, and it's government-backed mortgage securities. With FHA, There's no private mortgage insurance, again, because FHA is the government is the first. Oh, do you have a question? Nope. Okay. So with these government loans, the government, they write the rules. They tend to be a little more expensive on the, at least FHA, a little more expensive on the insurance side. FHA has both a financed mortgage insurance premium of 1.75%. And then if the borrower is making a less, 3.5% down payment, say, they have a monthly mortgage insurance premium as well. So FHA can be a little bit more expensive on the mortgage insurance side. The benefit is that the borrower, the allowance for maybe some credit issues, it's not as expensive if the borrower's had some credit hiccups along the way. FHA has a fantastic co-borrower program where parents can co-sign for kids or a relative can co-sign for, another relative. Income is combined, debts are combined, and there's no qualifying requirements based on the occupant borrower. So if you're in a co-borrower situation where it's minimum down, FHA will probably be one of the programs your lenders look at, I would say, probably pretty quickly. Some of the negatives with FHA compared to conventional, again, back to that mortgage insurance. Generally speaking, well, always nowadays, with the borrower putting down less than 10%, generally FHA, they're going to put down 3.5%. That monthly mortgage insurance, they have it for the life of the loan. On a conventional loan, that mortgage insurance can be removed if the borrower pays down the loan to 80%, or after 2 years, the property appraises for where the loan to value is 75% or less between the second and the fifth year. So there's some advantages to the conventional mortgage insurance. It's removable, tends to be less expensive than the FHA insurance also for most borrowers. One of my favorite programs, without a doubt, is VA. VA is insured by the Veterans Administration. It's the best zero to low down program out there, bar none. Very flexible underwriting, at least credit underwriting generally for the veteran. They do have what's called a funding fee that ranges generally between about 2.3 and 3.6%. But again, that's financed and there's no monthly mortgage insurance. So it's a great option for people that, veterans especially that, have zero down and want to get into a house. I know with your market down there, you're next to the air base, right? Isn't there an air base down there, Dan? Is that correct? So probably run into a lot of veteran active duty or retired veteran type buyers. So those are kind of the classifications. I'm not going to get a whole lot into the specialty loans, other than just to, you're going to want to, like, if you've got a borrower that wants to buy land and do a custom construction loan, connect with somebody that knows about custom construction loans versus maybe the run-of-the-mill loan officer. And generally these are going to be, like I say, community banks that specialize in those. So let's see here. So let's get into some of so we have kind of the umbrella of the different loan program types. Let's get into some of the loan approval components. These are things like income, credit, property. I'm going to start with income. Generally speaking, most programs require income to be calculated the same way. It's not exact every time, but that's a general statement that tends to be kind of true. Lenders, after the kind of the housing crisis back in kind of 07, 08, lenders now are required to adhere to strict requirements on how they document income and how they calculate income. One of the most important requirements is that they document a borrower's ability to repay the loan. It used to be where somebody could tell you, hey, I make $10,000 a month, and you could take them at their word and put it down, and as long as they had good credit and cash to close, nothing was verified. Those days unfortunately don't really exist anymore. So we have to document. Lenders are required to document everything in a specific way. Specifically, stability of the income and continuance of the income for at least 3 years. Generally, if you have stability, as long as there's nothing else in the loan file or the lender doesn't come across anything else, it's assumed to usually continue for the next 3 years. If a borrower to disclose, hey, I'm going to close the loan and retire tomorrow, well, then we don't have that continuance. That could be a challenge. Hopefully, they wouldn't tell us that if that's the case. Let's talk about credit. Generally, most lenders will be between, they're going to require their borrowers to have minimum credit scores in the 620 range. There are some lenders that will lend FHA and VA loans with credit scores under 620. But generally that 620 to 630 level is kind of what I see out there for most lenders, where they want, they want a minimum score. But FHA does allow scores down below 600, as does VA. Doesn't even have a credit score requirement. Usually when you get to those lower credit scores, there's some other things going on that, although it's, not credit, the credit score is low, they might have, unpaid loans that are in default, bankruptcy, foreclosure, unfortunately, things of that nature. There are, depending on if it's a bankruptcy, foreclosure, a deed in lieu of foreclosure, forbearance now is one that lenders are seeing, people that have applied for forbearance. There are extenuating circumstances and significant credit event charts that we look at to kind of see what's going on with the buyer. For example, a bankruptcy with conventional loans, they want to see 4 years from the discharge date if it's a Chapter 7. FHA, VA tend to be a little more lenient, 3 years, 2 years, depending on the loan program. So that, credit is good credit, credit scores are going to be, the same type of credit report is used for each program. It really just, if you've got somebody on the lower side of the credit scale, say 620, FHA is probably, if they've got minimum down or less than 10% down, that's probably going to be the better way to go. The mortgage insurance will be less expensive than on a conventional loan. Let's see, assets. One of the byproducts of the the housing crisis is the Patriot Act, where lenders are required to document all funds that are associated with a real estate purchase. And there's requirements on how we do that. For example, usually what we ask for are, the last 2 months bank statements for any account that's going to be used for down payment, closing costs, as well as any reserves that are required. And part of that requirement, and I typed this phrase probably, well, at least hundreds and hundreds of times, if not more, on when I'm sending a list of documentation requirements to the borrower, all pages, please. Lenders, if the document says page 1 of 8, lenders are required to get all 8 pages, even if the last page is blank, or it says this page intentionally left blank. They always want to see that. And as that applies to other documentation, same with other documents where there might be multiple pages. Generally, lenders are going to want to see the entire document for the most part. Let's see, cash on hand. Unfortunately, if there are some rare cases where cash can be used, but I'm trying to remember the last time I saw it used successfully. It would have to be a scenario where there's absolutely no history of banking. You'd have to, it's very rare, but there are some programs, it's some first-time home buyer programs where we can document cash on hands, but it's got to be done a very special way. So generally, bank statements, 2 months bank statements are going to be cash to close. Gift funds, there's a certain way to document gift funds with a gift letter. Also, we have to document the transfer of the gift from the donor to the receiver. So the donor can't just give cash. Again, there's that word cash. So, and these are things your lender will help.
Before we get too far in, any questions on what we've gone over so far? I see some blank stares because it tells me that we've gotten too far in the info, and this is where you can ask questions to help shine some light.
If you've got any of these items that have come up and maybe you wondered, well, why is it that way? Please ask.
I have one question about the stability of income. How far back is it? Like 2 years? You need to verify their job, same sort of job. Like if they switch jobs, if they haven't worked at the same place for 2 years, at least if they bump up, maybe is that still acceptable? Is it 2 or 3 years?
So generally speaking, the lender is required to document 2 years of employment history, 2 or more. So the last 2 years. Now, if you've got a college student that's graduated, comes out of college and just started a job, as long as we document that they've graduated, we can definitely generally use that income, as long as it's documented. We can document its continuance. Now, when it comes to job changes, that can be a little trickier. If we've got somebody that say has a gap longer than 60 days in a job change. If they're going into a job that has variable hours and variable pay, we might not be able to use that income right away. It might take 6 months. So each one of these cases is going to be very unique to the situation. Variable income is a term that's used for, you have a salaried borrower that works 40 hours a week and you know what their income is going to be, you can use it. There's a lot of borrowers out there that have what we call variable income. They work hourly maybe, and they don't, some weeks it's 26 hours, other weeks it's 38 hours or 42. And those tend to be scenarios where we average the income. If we have a situation where the borrower has changed jobs frequently over the last couple of years, and maybe they haven't had gaps in employment of longer than 60 days, that's probably a variable income scenario where we would need to average that income, unless they went to work for a full-time salaried type position. And we could document, full-time, 40 hours a week, salary type scenario. That's a good question. This income question is probably something that trips up a lot of lenders. They end up trying to use too much income to qualify. And a lot of times with these types of loans, you really have to go and get all the W-2s, their current pay stub, and sometimes even written VOEs to figure out what you can piece together to use as income. Does that make sense? Is that answer your question? Okay.
Yes.
Okay.
In one scenario, let's just say if they change jobs because they got a better job, but the same field, it's the same field of work. Maybe it's a little bit higher pay, and you could still consider their new job, as long as it's how long though, if they're on their new job. Or
it depends maybe on what that new job is. If and I've seen this. So if let's say you've got somebody in a tech field, they're making, I don't know, $85,000 a year now, and they get a new job with a tech company, and maybe they're making $100,000, and it's salaried, full-time, strong past job history. Yes, you'll be able to use that type of income. If it's a scenario where you've got variable income, meaning their hours fluctuate a little bit, not a lot, but even a little bit, and then they get a big pay raise, you might not be able to use that big pay raise. Now, if they were full-time, then they got a big promotion or something, generally you'd be able to use that income, as long as if they were working full-time without any gaps in employment the last couple of years. Every one of these scenarios is just a little bit different.
Okay. And then what about self-employed, like contractors? Let's say a roofer, Joe Smith, he's a roofer. How long do you need to go back, and I understand you would have to average. Here in Arizona, we have more sunny days. So it's not like back east where the roofer got to work for 3 months or 4 out of the year. But
generally a lender would want to see if they're when you say contract worker, are they self-employed then, or are they working on contract maybe for somebody?
Yeah, self-employed people.
Self-employed. Generally, a lender is going to want to see, and I say generally because there's some exceptions here, but generally they're going to want to see 2 years of tax returns to be able to average that income. Now, with the COVID going on right now, there are some additional overlays when it comes to self-employed borrowers. A lender's got to look at, okay, what has the earnings trend been the last 2 years based on their tax returns? What is it based on their year-to-date profit and loss that the borrower would give us? And here's the overlay. What have the deposits been into their business bank account the last 2 months? Lenders now on self-employed borrowers are required to look at those business bank accounts to see what kind of deposit activity, to make sure that's in line with the year-to-date and the last 2 years. And when it comes to a year-to-date profit and loss, so we can, that's the borrower basically telling us how their business is doing this year. Generally, those year-to-date profit and losses don't really help you. They can only hurt, they can only lower the income. A lender's not going to give it additional. If the year-to-date is higher, they're not going to use a higher number. But if it's lower, they'll use the lower number. So is that, again, when it comes, especially self-employed borrowers, I always am a big advocate of get them started on the process as early as possible, just because there is more paperwork. And if they are having to put together, a lot of small Schedule C employees maybe have never even done a profit and loss statement. And I have a form kind of that I set template that I send them to help them through that, but they still have to do that in order to be able to meet the lending requirements nowadays.
Okay. Thanks, Reg.
Let's see, any other on kind of what we've covered? I'm just looking to see if I had some other things in my notes here.
I have a question.
Sure.
IRS tax transcripts.
Mhm.
Scenario is a VA loan, and
Okay.
they have a rental. And so this is the first time ever hearing something about requesting a tax transcript. Just a second.
Yep.
Transcript concerning the rental. And have you dealt with the IRS on that side of things?
So the tax transcripts, so yes, many times. So on just about every loan, the borrower will sign a 4506T transcript request. Some lenders will, on a self-employed loan, they'll want the IRS transcripts back prior to issuing a clear to close. I would imagine. I don't know of any lenders that aren't doing it that way. And those tax transcripts, I think they're coming back fairly quickly. Did you have a situation where it didn't come back in time, or it was just right at the end and they didn't realize they needed it?
It was right at the end. Underwriter asked for it, and unfortunately my client is overseas, so when he calls the IRS, the number is overseas, so it won't let him get through to anybody because it is the out of country phone. So we're having issues getting IRS to release the tax transcripts to the lender.
Okay, so because generally that's more of I wonder if that's an automated process. I mean, other than the borrower filling out the form properly, having the correct, borrower, the address, their name spelled, social security number, the borrower signs it. The lender then submits that usually through a third-party company, maybe like Credco, or there's a number of them that will then submit those transcripts directly to the IRS. But maybe maybe for whatever reason it wasn't. I wonder if the borrower hasn't filed their tax returns, or
No, the borrower actually gave them the tax forms and whatever their past 2 years. However, because of the rental, they're requesting them directly from the IRS. So I'm new to the business anyway, but even other agents haven't dealt with this either. So
well, it's usually a very seamless process. That's why you don't hear about it. Is it usually? And I've got a personal story that came up on a transaction I was working on last year. That it's a little different, but the transcript it's a fraud control. Really, what it is, it's a fraud control process the lender uses to make sure that the information the borrower provides the lender on their tax returns is really the same information that is filed with the IRS. And in 99.999% of the times, it is. 15 years ago, 10 years ago, probably there was a lot more shenanigans going on with fraudulent tax returns. But I think most people know now that the lenders are going to do these fraud control measures regardless. They do it on almost every transaction. It's just unfortunate that yours, for whatever reason, you can't get those released. I had a deal, like I say, last year where we got all the way to final underwriting, and the borrower, I got a call from the underwriter. And the underwriter said, "Hey, we have a problem." I said, "What's the problem?" I figured we were going to docs and it was going to close and everything was good. Well, the borrower had provided the tax returns they provided me. He was self-employed, it had commission income and some other things going on with partnership. But anyway, on his self-employed Schedule C business, what he filed with the tax return was much different than what he gave to me. And there was no fixing that. I mean, the loan was declined. The borrower had no explanation, quit returning my calls. So that pretty much told me that, yeah, he knew. So yeah, unfortunately, you don't see it very often. It's the only time in my career I've ever had a 4506T come back and there be an issue. So it's probably something you don't run into very often, thank goodness. Maybe sometimes when borrowers don't file the tax returns, that's when we usually get a no hit, or then they have to file them. But in this case, I'm not sure why it's a problem for you. You'd have to talk to the lender and see if they can somehow, given that it's just a rental, unless the underwriter noticed something unusual about the rental activity, maybe they can somehow make it post-close or do something like that. I don't know. You'd have to talk to them.
Yeah, I talked to them, and that's just it. They won't move anything on the loan until they get those transcripts.
So they get the transcripts. Oh boy. Any idea on ETA? Was anybody else able to give you any estimate?
Well, they asked for them on the 14th from the IRS because they, the lender's now requesting instead of the member. So I don't know how long it takes for IRS to really kind of get back to them. So we're waiting on luckily my client will be in country in the US tomorrow. So hopefully.
Okay. Yeah, if he was here, he could go down to an IRS office and probably get those himself in, whatever city he's at, but that's too bad. Well, I hope it works its way out. It probably, I'm sure the information is probably fine. It's just, needing the lender needing the piece of paper to check the box, right?
Yeah.
So that's kind of the world that we've evolved in, where due to the housing crisis, a lot of guidelines and a lot of underwriting aspects used to be discretionary, and lenders could follow up post-close with things, but most of that has gone away. There's a lot of lenders are just, if they don't have it, they don't close. I wish it wasn't that way. We need a little more discretion built back into the system, I think. Let's talk about, if there's any other questions on this. Okay, let's talk about property. So each loan has generally, I would say all, conventional FHA, VA, generally somewhat similar property requirements, minimum property standards. The FHA and VA, when you read their guidelines, when you read the rules, they read very similar to a conventional loan. However, there does tend to be, sorry about that. There does tend to be, I would say, at least in my experience, more work orders on an FHA or a VA appraisal as compared to a conventional loan. And there are some hot buttons that the government lenders have. Anything health and safety is always going to be a red flag, where maybe on a conventional loan, even like a hand railing missing, an appraiser will appraise it as is. But on a government loan, things like handrails, and I'm sure you've all seen these handrails, peeling paint, roofs, at least the Seattle roofs are a big deal because of all the rain we had. That's where I just moved from. So like anything else, I think appraisers are human. And when they pull up to the property, if it looks well maintained and taken care of and not overgrown with weeds I think the appraisal will tend to be, cleaner. One of my friends, and value supported, and it'll just be an easier process. One of my really good friends just went through a refinance, and his appraisal came in low. So he sent it to me. He's up in Washington. It's a duplex, an investment property. And he thought it was literally $50,000 or $75,000 low, way low. Well, I started looking at this appraisal. It's got peeling paint. It's all overgrown with weeds. It looked to me like maybe the deck had some rotted boards, but it came in as is. It had electrical fixtures just dangling from the ceiling. And I'm thinking, okay, the underwriter's probably going to call that out because that's health and safety. They didn't, but I think like anything else, if there's property components that can be fixed or mitigated before the appraiser goes out there, it probably will make for a little bit easier process on the appraisal, especially when you're dealing with government loans. The other aspect of property is sometimes if there's different types of properties. So you may run into a scenario where it looks like a single family home, but it's really a duplex. So is it an unpermitted duplex on a single family lot? What's really going on here? And there's a term that appraisers will use and underwriters will use. It's called highest and best use. So if there's a question about the usage of the property, there's the government, Fannie and Freddie allow for non-conforming use as long as it's legal, but the appraiser has to say the current use is highest and best use. Has anybody run into some appraisal issues, work orders, or I'm just curious what what's an interesting one, or what's something you've run into that either was easy to resolve or created some issues?
With the appraisal itself or getting the appraisal?
The appraisal itself, but property, maybe a property issue that was unexpected that.
Oh, I guess the ones that I've had that haven't appraised, we kind of expected. So
Okay. Okay.
we had pre-planned for that. So.
Okay, and that's good. That's a good thing, right? If you're expecting it and you get it,
It makes our offers look stronger if we're able to offer cash in the initial offer in the case that it doesn't appraise. So that's helped us. But
okay.
If something were to be really off, I would run comps on it.
Anyone else? I ran into a situation recently on a manufactured home. It looked like a double wide in the pictures. I was told it was a double wide, but it was more like, and I've learned this term since moving here, it was a park model. Didn't know what that was. It was like a 1.5 wide. And I couldn't tell from the pictures. And luckily we never had the appraisal done, but we got that kind of sorted out. Before that, we got too far into it, but yeah, obviously 1 unit manufactured homes are a challenge. Leased land, is a challenge. Let's see, single family homes in commercial areas. If it's zoning is commercial, and and a lot of areas may have gone through a transition from single family homes to commercial. So if you've got a single family home in a kind of more commercial area, again, it's going to come back to highest and best use. What's that appraiser going to note in the report? If its highest and best use is commercial, that one probably wouldn't fly. Let's see, any other property issues other than, I'm just curious.
I had one come in below a value, but they did a drive-by appraisal.
Okay.
And she was missing 200 square feet, which is actually a lot.
That is a lot.
When you're counting as far as the value of the home. So anyway, it was hey, she didn't realize there was a permitted and approved by Pima County, and just didn't do her research because it's actually right there. I mean, it's not hard to pull. Everything's electronic on the actual permit. So anyway, long story short, we resubmitted, and I'm guessing it came way over value at that point.
Okay, so if they've made an error like that, you can most appraisers, they're not trying to kill a deal, or they want it to work. Most appraisers that I've met want things to go well, and if they make a mistake, they step up. My experience, they'll step up and fix it. It's not true every case, but I think they're good people. They want to do well. I'm trying to think. So, what was I on the appraisal piece? Value reconsiderations. You had mentioned a low appraisal. Has anybody ever run into a scenario where you had a low appraisal and you tried to resubmit maybe comps and see if you could get the value increased and it didn't happen? Has that ever happened to anybody? No? Okay, so it's in this market.
Wait, what was your question again?
Well, if you have a low appraisal, let's say you have a client buying a house at $200,000. The appraisal comes in at, I don't know, 180. Have you ever gone through a value reconsideration process with the lender? Is that true?
I don't know if this applies to what you're asking, but we just recently had one that didn't appraise at value, but on the report, like they listed all of the stuff from the assessor offer, but the pictures were from a different house. So we did request a reevaluation, but they didn't change it.
Did it not get increased? How long did that process take?
Definitely, the house was clearly much nicer, but it's fine.
How long, just out of curiosity, how long did that value reconsideration process take?
Like 24 to 48 hours.
Okay, so that was pretty quick. Okay, that's good. So I think most lenders, if not all lenders, have a value reconsideration process where if you do get a low appraisal, they'll ask.
I had to fight for it though, I tell you.
It's not, they're not easy. These value reconsiderations, lenders are held to a very high standard with regards to the property and the appraisal, and the appraisers they can't be deemed to be influencing those appraisers in any way. So they don't like to go through the process, but they do have a process. If you can supply comps, comparable sales, closed comparable sales of a like property, they will take that information. Many lenders have an internal appraisal department that review it first, and then they'll resubmit it back out to the appraiser to see if they'll reconsider their value. And in markets where values are increasing very quickly and rapidly because the sales velocity is up, like what we see now, it's not uncommon, at least in my experience, to have some low appraisals that the comps just haven't caught up with really where the market is. But those processes are not fun. They're tough, and to be honest, in my career, I haven't won very many of those battles. They're tough to win.
I know you probably covered it when you were talking about variable income, like bonus
Yeah.
structures. Was that a 6 month?
For what's that now?
How long do they need to be on the variable income to be able to prove it?
I'm going to say each scenario is going to be different.
Like a base salary and then bonus.
Base salary, if somebody's base salary and they've got a documented employment history, generally, as long as you get at least 30 days pay stubs, you're going to be able to use that under most scenarios, I would think. But that variable income, if it's, if they're self-employed and they've only been self-employed for 6 months, that's not going to work.
Yeah, I'm talking like somebody who's a W-2 employee, but they got like a small base. But their job is mainly salary or mainly bonus.
Well, bonuses, that's going to be different. So bonus income, overtime income, commission income, the lender, they can use more than 12 months, no less than 12 months. Generally, they want to see a 2-year history, but for that other income, if it's commission, bonus, they want to see 2 years, but they will oftentimes use less than a 2-year average if they have to, especially if the borrowers changed jobs and had that similar income in another type of position before. Similar pay structure in a similar type of role. Let's see here.
Bankruptcies.
What's that?
Bankruptcies.
What about bankruptcies?
Okay, what's the guidelines? How can we help people?
So if you've got a conventional loan, 4 years, 4 years, FHA 3, VA 2, there's what's called extenuating circumstances that, for example, on a conventional loan, if you can document extenuating circumstances, you can go 2 years, but you really have to be able to document the true nature of the extenuating circumstances via information that's in that bankruptcy filing. For example, medical. If somebody filed bankruptcy and there was hundreds of thousands of dollars in medical costs, that's going to be a pretty clear exception.
Is that now 4 years from the filing of it?
4 years from the discharge.
Discharge. Okay.
Those timeframes are generally from the discharge.
Okay.
Yeah, there are some filing nuances, but generally they're looking 2 years, 4 years from discharge.
I used to think it was 10 to 7. So.
But foreclosure, like for conventional loans, foreclosures are 7 years.
Okay.
So that's on a conventional loan.
Okay.
Okay. Any other questions on that?
Questions about the process, how to work through things, tips, tricks?
So find a lender you're comfortable with. That's, I think, somebody that you can be true partners in the process with. It all starts there. Somebody you trust, somebody that's experienced, obviously. If you're working with a borrower and you get kind of the feeling that there might be something else going on, it might be a little more complex, try to get them to connect with your lender as quickly as possible. Just that way the lender can vet through the specifics. My experience is they'll tell me things that they won't tell their broker, their real estate broker. And I'll get it out of them, because if they don't want to tell me, then we're not going to be able to get them a loan. So we lenders, we know how to get the information, document it properly. Prep them, especially the self-employed borrowers. The lender's probably going to ask for a lot of paperwork. Just, please do their best to comply as quickly as possible. And then the lender most lenders want to make it as easy as possible for the borrower, but there's still just certain documents that they have to collect. Property, when property things come up, if you have a question about a property, work through it with your lender. Is this really a duplex? Is it is it a manufactured home? What have we got? Put your heads together. Because I mean, one thing in this business, we all learn from each other, I think, every day. All of us do. And I'm still learning a ton every day. So I'll ask a lot of questions. I'm thorough, I think. So I tend to ask a lot of questions if something doesn't seem quite in the box, just to make sure I'm not missing anything. And like I say, the more prepared the borrower is, the easier the process will be. So if they haven't filed tax returns for 2 years, or they haven't, collected their documentation, anything you can do to connect them with the lender so they get started on that would be helpful. Even easy loans tend to be a little more challenging if the borrower can't find their documentation. Let's see here. I'm just looking at some other things that do you have many wells down this? Do you deal with wells? Do you see those quite a bit? Okay. Yeah. So you're probably using.
And septic.
What's that? And septic as well. Yep. Wells can be a little unique in that, especially where FHA and VA loans are come into play. The buyer and seller, they can't go out and collect their own water samples. They need to work through a water company to collect those samples. I had a VA loan once where after I sent exactly the guidelines out, they thought it would be okay to go collect their own water sample and walk it into the health department. And that didn't work. So we had to redo that one. But trying to see here if I've got any other.
Can you discuss on how many well share, like how many people can be on a well share because I know FHA and VA are different.
I'd have to be honest, I would have to look that one up. That's not something that I deal with a ton. So I could look that up if you want, and I'll email those. I can pull the exact guidelines with wells, and I can send them to Dan, and then he can distribute to everybody. Would that work? Okay. Yeah. I'll look that up.
Sometimes we can't show a person that's trying to get a loan for FHA or VA, and then we show them a property they fall in love with, and then come to find out there's more than 4 people in a well. Now they can't qualify. So it's good to have that information.
Yeah, no, I will pull that in. And when it comes to not only things like that I look up, there's a lot that I still look up because things change, or it's changed several times over the years, and I always like to have my eyes in those manuals just to make sure that information is accurate. So I'll look that up. I'll get that out for both FHA and VA to Dan. Now, keep in mind, these will be the guidelines right out of the HUD manual and right out of the VA lender guide. Some lenders will have additional overlays. And that's not a term I don't know that you've never heard. There are things called overlays where, whether it's Fannie Mae, Freddie Mac, FHA, VA, there's the base guidelines. But it's pretty common for lenders to have overlays and maybe a more restrictive policy around things. And it's whether it's credit score or wells or manufactured homes, or it could be a number of areas. So I would say I'll send you the guidelines, but check with your lender for their specifics in case they're different.
Now, on the testing of the water wells, is it just the health department has to send someone out, or is there like an environmental associate?
So generally there are water. Well, in Washington, there were certified water operators, companies, and they would come out, inspect, and many borrowers would want to have a well inspection done just to make sure the pump is pumping the right gallons per minute, and those people are authorized to take those water samples and submit them to the health department.
That's good, because I know a lot of times the health department is way understaffed. So
yeah, especially now with this COVID thing, I imagine it's taking even longer. Any other kind of general questions or whatnot, Dan? Anything that I didn't hit on? That
Cindy, got something?
I was just curious, how would you advise clients about using their credit cards during the process?
I would advise them, well, going back even kind of a little higher up, please don't open any new credit during the process, whether, buying a car or walking into Home Depot and opening a Home Depot credit card because it's 10% off. Please don't do any of that. When it comes to their credit card usage, as long as it's within there, each borrower is going to be a little bit different, but unless there's a situation where we have really tight ratios, and when I mean tight, I'm talking, 49%, they're right at their maximum. As long as they don't deviate too much for their regular spending, it won't impact things too much. It's when they apply for new credit, or maybe they run a credit card, maybe the balance is 1,000 when they meet with me, and then they run it up to 5 or 10,000. That will fire an alert, and we'll have to use that higher payment. And I most lenders, I think, coach their borrowers around that when they meet with them. Hey, keep your spending in check. Let's no big purchases until this is over.
Okay.
He's got a couple more minutes of his time, guys. Use it.
And like I say, feel free to reach out to me. I'll give everybody my cell phone. I don't know if you have my contact information, but my cell phone number, I'll give it to you here, is 206-948-3671. And my email address is rosburn, OSBURN, at introlend, just like it sounds, .com.
Awesome, guys. Well, this is Rich. He's going to be on these calls at least once a month for us. So bring some questions, weird situations that come up. We have him as a partner here at the Market Center. I want to utilize him. Even if they're the most obscure thing possible, I want to bring it out just the event that you deal with it. We can have him help us through it. And then you, on the other side, don't have to learn from your own mistakes. We can learn from other people's, and we can find a better way through the process. And this goes for both listings and sellers, knowing your product types, knowing your property types, and how to levy the both in your favor. So good stuff, Rich. Thank you so much for joining us. We do appreciate your time and look forward to having you on the next one.
Great. Thanks, everyone. And I'll get that FHA VA information.
Awesome. Thank you.
Okay. Thank you. Have a good day.
Thank you.
Thanks, Rich. What'd you guys think?
Good info.
I thought you guys might need something like that. It was a little bit more structured for other things. What else do you want to know? What else do you want to learn?
In general or lending?
I was like, what class do you want to bring up? I want to bring in some other people to help teach classes too. So you can get some wider berth knowledge, title, lending, property, home inspections. You tell me what you're needing, and let me see if I can fill those gaps.
I would like title.
Yeah.
I mean, as much as I ask us like 800 questions to title on a regular basis, but I think for somebody to kind of break down the actual logistics of it, I think would help better when talking to my clients.
Okay. Understood. Let's all work on getting that out. May not be next week, but it might be the week after. I'll get a title rep on here, see if I can't get Kathy Fowler.
I'm sorry, title, not TSA. So escrow, not title. Sorry.
Same thing. I know what you meant.
Well,
Title and escrow are the same program.
okay.
So awesome, guys. Well, I'm going to cut you loose. It's 3:28. If you have not done so, we need to get you on the calendar for your GPS so we can go over that for the year of 2021. So I know where you're at in your goals. What we need to do to get you there and start thinking, what am I going to do for the rest of the year that's going to set me up for a fantastic 2021? Right?
Okay.
Head nods. You guys head nods. Okay.
Are we supposed to use is that the GPS one?
Yes. Amber's got hers on her desk.
Woohoo,
Go to
Amber.
theonething.com, and get the GPS form there. Or if you just go into the file structure of our GroupMe page, I've shared it no less than 5 times.
I found something that I'd like to share, but I think I'm going to get Rich to go over it. It's like the home buyer loans and programs, and it breaks down all the different ones. And it's a really nice, like cheat sheet of what he was talking about. And it even includes the Arizona, Department of Housing, different plans and programs, but I want to get him to kind of fine tune it, make sure that everything's good. And then I'm going to
Email it to him. He'll gladly do that. I know he's looking forward anyway as a partner. So
Yeah.
awesome, guys. Thank you so much. Yes, Amber.
I was just gonna say, Deb Godstad, I mean, before she left, she provided clear like worksheets that would, it's so helpful. I don't.
That's what I
them
have too.
because
It's awesome. I love
Yeah.
it. Yeah.
It's,
It's separated out into columns and
yes, I gotta go. I have to take a phone call, but I'll talk to you guys later.
Share with me what you have in those and maybe we can get them recreated.
I don't know if I have
Scan and share.
I don't know if I have a copy of it anymore.
Yeah, if you can, email it to me. Even if it's filled out, we can break it down, recreate it.
Yeah.
So awesome, guys. I'm gonna cut you loose. I gotta get run to it.
Okay, bye.
See you in the morning.
End the call. Come on.